right. Welcome back to the Built to Grow podcast. I'm your host, Tim Lyons, in a special Zoom out of the mountain cabin podcast, joined by Randy Angston, as always. What's up, buddy?
How we doing?
Good. And we have a special guest today, guys. Today, we've got John Briggs. He's the owner of Incite Tax, and he's on a quest to protect the unfairly treated taxpayer from massively overspending on taxes. A man of my heart here. He's the author of First For Microgyms, a book that I have on my shelf today and read many times, which covers cash flow management systems for gym owners. And he's also releasing a new book in January titled The 3.3 Rule, the new Workday standard of creating more by working less. John Briggs, welcome to the show.
Hey, thanks for having me, Tim, Randy.
Yep. Absolutely. And John, we've worked together. I've started by reading your book. It was mentioned on another podcast several years ago at this point. Read it, loved it. It was kind of my second introduction to Profit First methodology. But then I ended up hiring your team to kind of set up our systems for Profit First. So we've worked together, man, and your team did a great job. Appreciate you.
Yeah, well, I'm glad we did a good job for you. That is our goal.
Yeah, that's the goal. And Mike Michalowicz, who's come and spoke at our Growth Summit. He's also spoken to our mastermind group, the Iron Circle. We had him come out and speak to us, kind of like the creator of Profit First. But then you drilled down and created like the niched version for microgym. So how does that work? I mean, you got the Profit First system, and now you've got I think there's a real estate one and probably a dental one, and you got a microgym one. How does that work?
Yeah, so almost 5 years ago, I think we're going on, Mike noticed that some of us who have niche audiences, we were tweaking the system a decent amount. And he said, hey, you know what? Why don't you license the Profit First brand and the methodology and write your own book, because it'll serve your audience better. I was the third one who took on that challenge, because what we had found is we're implementing the Profit First system. It's like, okay, we need to tweak that. And his percentages for normal businesses that he looked at, that are across the board manufacturing service based, I'm like, his percentages don't work as far as what owners should be paying themselves, what the profit should be, like those types of things compared to gyms. So I felt like, let me do my own study. Let's look at financially fit gyms. Let's add the two accounts that we're always adding anyways to what he was doing. And, the rest is history. And to your point, honestly, at this point, I think there's more than 10 derivative books, as we call them. Yeah. Chiropractor, awesome. Realtor, real estate investor, dentists, landscape people. I mean, yeah, it's grown quite a bit for him.
Yeah. And you were an accountant first, right? If I don't remember. And then you ended up buying a CrossFit gym. Tell me what the heck you were thinking when you bought that gym.
Yeah. So I don't do drugs, but some people think that I did based on that decision. I'd been going to this gym. I liked working out, and we had a bunch of CrossFit clients. So I thought, let's go to the gym, and that'll help me experience it. And I noticed signs around the gym. I thought, based on my experience with the hundreds of clients that we have that are gym owners, I don't know if this gym's doing very well. And it took me enough at that point in my life to have the habit. And kind of selfishly, I'm like, I don't want to lose the habit. I don't want to lose the location. Like, I have a routine. And I know the danger when our members leave, they potentially don't ever find another gym to go to because it totally throws off their behavior. So I just sent an email to the owner. I said, hey, you don't know me. I'm the guy that's like just above last place in all the workouts. But I work with a lot of gyms, and my guess is, based on what I'm seeing, you're dealing with X, Y, and Z problem. Now, he should have, and appropriately could have, responded with, dude, I don't know who you think you are. Like, stay in your lane. Just enjoy the classes while they last, maybe. Instead, he invited me to lunch. And he said, actually, I've tried to sell this thing 3 times. The first time I got a deal, but then thought it through, and I didn't like what the guy was going to do with the community. So I turned that down. And the other ones, we just didn't end up working out quite on valuation. So he's like, do you want to buy in? And I thought, There's no other CPA I know that's working with gyms that also was a gym owner. Thought this could be a good differentiator for us. Plus, I wanted to know when I suggested things to the team, like, hey, we see gyms, offering a variety of services, but personal training, group classes, nutrition, semi-private, those are all like common ones that we might see. You're doing just group training. Like, then we go to the coaches to say, hey, we'd like you to do personal training. You're going to make more per hour. On paper, we knew what that looked like. And now that I've lived the experience, I now know that all the coaches almost were like, no, this is ridiculous. I don't want to make more per hour. You can't ask me to do this. So now I've lived like the human psychology side of what the numbers tell us that we should do. But that was ultimately why I got into it. And, it was a good educational ride for me.
Yeah. You glad you did it at least?
Very glad I did it. Yeah.
Okay. All right.
We talk all the time that the skill sets it takes to run a gym are some of the toughest, I think, when it comes to the business, the business options that you have available. The product that we sell is not exactly desirable, much to your point, right? But if you could do it and you could do it the right way, and when the math adds up, obviously we've seen success in those realms.
Yeah, well said, Randy. I think gym owners need almost more of a degree in psychology than like the business operating stuff. In my, 10 years of experience up until that point running the CPA firm, I never had a client tell me, hey, have you thought about doing this with your tax practice? But gym owners, you literally deal with members every single day saying, hey, have you thought about doing this? Or I don't like the way you're doing the programming, or I don't want to do it that way. And like having to balance the minority squeaky wheel with what is actually what you want to do. And if you don't have mentor support like you guys offer, you're going to flip-flop on ideas. I mean, it was tough.
It's a tough run. And yeah, you're right. I never even really thought about it. You get a lot of unsolicited feedback from the clientele. Like they have no clue. It's just what they want. So I get it. There's passion. This is their third home or whatever, second home. So let's get into some numbers and taxes and stuff. And I was kind of mentioning to you, John, before we got on this call, like your book was the first one that gave any true guidance on what the margin should be and what kind of allocation should be for different, call them buckets or kind of categories. Obviously it comes from Profit First. You said you tweaked it. And I'm glad you did it because there isn't a lot of education in the fitness industry about like, what's good, what is bad, like what's a good profit margin. You work with tons of gyms. Is fitness kind of still one of your main kind of niches categories, or you branched out now?
I mean, yeah, from a marketing standpoint, we do a lot of marketing for gym owners. We've grown quite a bit. So from a percentage standpoint, while we have more gym clients than any other accounting firm in the country, we're at about 450 gym clients. But we have thousands of other clients. Sure. Kind of a concentration, e-commerce, real estate.
Nice. Okay.
Yeah.
And so, your I guess your guidelines, you said this is what a good gym looks like. Does that still hold true? And like, what would you say, like, hey, if a gym's doing this in net profit a year, that's a pretty dang good operation.
Yeah, they still hold true. We still think about 20% kind of puts you in the echelon of financially fit gyms. And we've seen people like you and others really help people push the boundaries, and they're getting to 30%. So like, yeah, 20% is great. 15% still is like, hey, respectable, but maybe you can tweak some things. If you're at 10%, you're basically break even, and you need to have some urgency in making changes.
Gotcha. And you've seen a lot of gyms, P&Ls, and I'm sure you've seen huge gross revenues in zero profit or negative, right? Like, I mean, it doesn't matter how much you make, it's how much you keep, right?
I mean, what comes to mind immediately is a client I had he's still a client, 5 locations. Gross revenue for all 5 locations was around like the 1.8 million mark. Net income, 150 grand. Another client, gross revenue 350 grand, net income 100 grand. It's like,
Yeah.
do I want the
Yeah.
headache of 5 locations and all these other people for the same outcome? Now, that being said, a lot of potential, right? As soon as he became a client, we tweaked some things, got the profit first system in place, and we saw that profit margin increase. So there was a lot of potential there. But to your point, like revenue top line, I mean, in fact, I don't know if people follow, but the Inc. 5000 list just came out a couple of weeks ago, glorifies top line revenue. It's not what you make, it's what you keep.
Sure. Exactly.
Yeah.
Financially sound businesses. And like to your point, yeah, that smaller gym, that guy's get basically the same, I guess, net take home or whatever, net profit. He's got
benefit.
no headaches or minimal headaches compared to the
Less.
other guy. Yeah. Less.
Definitely a lot more time, freedom of time.
Right. So let's talk about how you work with gyms right now to kind of mitigate taxes. I know there's a book that's probably this big, right? Of the tax, where is it? Tax code. It's like, and you probably have it on your shelf and you sleep with it underneath your pillow because the thing changes every 24 hours, right? So what are some of the most common things gym owners can do right now to say, hey, you know what? I'm taking in some profit. Obviously, the more profit you have, I'm sure there's other ways, but in my life, it's like K1 distribution to an owner. It comes right to your personal taxes. Then you owe taxes on the profit. Like we want to mitigate taxes as much as possible. Like what are the most common things that you teach gym owners to kind of help with that?
Okay, let's go over 4 things. Lowest hanging fruit is correct entity. So an entity is your classification: LLC, S corporation, partnership, corporation. Some have it under just their social, so they're sole proprietors. The entity selection is super important because most of them come attached. You have your income tax, and then they attach a self-employment tax on top of it. So as a business owner, you're the employee and employer. And so sole proprietor, active member in a partnership, single member LLC with no other type of election, all of those have this self-employment tax tied to it. S corporations allow us to not have self-employment tax tied to everything. So with gym owners, depending on the other stuff they have going on, we always recommend somewhere in their structure that they have an S corp so that they can avoid that 15.3%. So that's the lowest hanging fruit. If you're not sure what to do there, like talk to your tax accountant. They should be able to help you with it. I don't want to bore you all with all the details of the differences and things, but S corp is definitely something you should be considering if you're a gym owner. The next one with that, if I am an S corp, so the IRS noticed, hey, these guys don't pay self-employment tax. How? Okay, what other ways can we screw the taxpayer? Let's see.
Yeah.
So they force you, if you work in the business and you're the owner of an S corp, you have to pay yourself a reasonable compensation. You have to. So you are going to issue yourself a W-2. In fact, sometimes people avoid creating the S corp because they feel like, that overcomplicates things. I promise you, if your net income is more than 10 grand a year, the S corporation makes sense, even for the extra headache that an accountant can deal for you.
Yeah.
So I pay myself a W-2, but the code says it needs to be reasonable.
Right.
So there's not a mathematical formula. And what we have found is a lot of CPAs get to the point where you kind of feel like they work for the government and not for the taxpayer. And so the dollar amount they recommend on this W-2 is way too high. Why does it matter? Because as a W-2 payment, you are paying the payroll tax. And because you're both the employer and employee, it is the self-employment tax of the 15%. So we want that as low as possible. We want to benefit from having all of our net income not subject to this self-employment tax, but we got to be compliant. So making sure your W-2 is as legally low as possible is the next step in that journey. Third one, the mindset. The tax code tells us in order to write something off, it needs to be ordinary and necessary. Well, let me tell you what about those two really vague words. What you and I think is ordinary and necessary is not necessarily what the IRS agrees on.
Sure.
It's too vague. So, people complained of the AICPA, which is a big CPA organization. They said, hey, you guys got to give us clarification. So they put a crack squad of their smartest human beings together. And this is what they came up with. We'll clarify it with two more words: helpful and appropriate.
Okay.
Wow. Thank you for the guidance. So it doesn't help us. And this is the way I help people interpret those four words. If I'm spending $1, is it related to my business in any way, form, shape, fashion, any way possible? Then it's a write-off. Because here's the thing. Let's say you didn't know in the 77,000 pages that there was this one little exception for one little expense that you thought you could write off. If you're audited and I can explain to the auditor, hey, this is why I thought it was a write-off because it's related to my business in this way. Worst case scenario, they just say, yeah, but there's this weird exception. So you're gonna have to pay tax on that amount. Okay, fine. I owe tax at that point. If I don't have a story and I don't know how to connect it, like a client who wanted to write off $100,000 belt buckle, I couldn't come up with a way to connect that. No. Yeah.
It beats mine.
Right. You're screwed because the IRS is going to be like, oh, you basically committed fraud because you have no idea why you paid for this out of your business. So as long as you have in your mind a connection to your business, then you should be paying for that expense out of your business account, write it off on your profit and loss statement. And that's the easiest way to think about it. And that little mindset shift for most of our new clients, I mean, you're talking a few $1,000s in tax savings because there are things they're spending money on that they didn't necessarily realize were legitimate business write-offs.
Helpful and ordinary, or whatever those two.
Ordinary, necessary, helpful, appropriate.
Yeah. Okay.
Oh, that's great. Okay, and then so the fourth one. This is an amazing tax strategy. Everybody should be doing this, assuming your gym is profitable and has net income. It's commonly called the Augusta rule. Yeah. We like to call it corporate rent because corporate rent is much more descriptive of what we're doing with the strategy. But for those of you gym owners who aren't aware, once a year in a city in Georgia called Augusta, these guys obsessed with a green jacket go down there and with, taking their sticks and balls playing around are fighting for this green jacket. They call it the Masters Tournament. It's a professional golf association, the PGA, like their Super Bowl. So what happened is Augusta's not a very large city, but it is a very wealthy city. And the owners were looking at, wait, hold on. Okay, all the hotels are at capacity. There's still a lot of other people coming in. They're paying how much for the tickets? Oh, I can rent my house out for $5,000, $6,000, $10,000 a night. Oh yeah, I want to do that, but I don't want to pay tax on that. So most people don't realize, but the tax code is as long as it is because wealthy people and really wealthy big corporations pay lobbyists to get bills passed that favor them. And you know what? That's totally awesome.
Yep.
I love it. And so we're just going to take advantage of it. So they paid someone to go and they got this tax rule put into place that helps them. So the tax rule is if you rent a property for more than 14 days, it is considered a rental activity at that point. Therefore, you have to claim the income, you get expenses, it's filed on your tax return. But 14 days, that's the magic number. If I have a property and I rent it for less than 14 days, it is not by definition a rental activity. Therefore, any income I receive off of it does not need to be claimed. So we take that fun little rule, we combine it with the normal practice of companies holding board meetings, and we say, let's have your business, let's have your gym rent from you 1 day a month for your monthly board meeting. Your business is going to take a rent expense. And because you're renting your house out for less than 14 days, You don't have to claim that income anywhere. The standard rate that we use on that is $1,250. It's kind of a national average. You can check on like a short-term rental type of website. Same house size, similar geographic area. And if it's renting for more than $1,250, take a screenshot of that. That's your evidence. Use the higher amount. So we have some clients in New York City or have bigger houses like $3,000, $4,000 for the day use. At $1,250 alone, that creates a $15,000 rent expense, which is going to save you $3,000 to $6,000 in taxes. It's one of the best strategies ever. We call it the Augusta rule.
Let's dig into that a little bit more. So not only are you taking $15,000 off your taxable income, you're also receiving the funds from yourself. You've paid yourself without payroll taxes. It's just, call it free money, but you've given yourself $15,000 personal income without taxes, and you're saving another, whatever it is, $6,000 based on whatever the percentage bracket you're in off of your business taxes. So it's a triple win.
Yeah. It's amazing.
So let me ask you this. Is it per property?
It's per property. Yeah. So we have some clients who have second locations, maybe like a cabin. Look, there's nothing that prohibits them from renting that out for a monthly board meeting. Now, some people are like, I have a cabin, but I also have it listed on Airbnb. Again, it's 14 days. So if you've rented this property out for more than 14 days, the strategy doesn't necessarily work. So it is per property.
So
smart.
Hold on here. Let's dig in even more. So if it is listed on Airbnb and you've rented it over there for more than 14 days cumulative or whatever, you can't take the first 14 days and do tax-free? Or once it's past 14 days, the whole thing
past 14, it's a rental activity. Yeah.
So case in point, we're up here right now, both of us in my cabin in the mountains. It's not on Airbnb. It's just my second home. So we're paying myself rent to be here for 14
That's
days. Right. If we use it for more than 14 days, but don't pay for the 14 days, and there's no income exchange of those other 14 of the next 30 days, it doesn't matter, right? It's just the 14 days of income. All right.
It's your property. You can use it for personal use. It's just your business is going to rent it up to 14 times.
Yeah. For these podcasts.
We're doing a podcast right now. We're renting my house or my cabin for myself. I love it. You know, we're well over that rule has been a game changer for us. Also, you know, I've got my daughter on payroll as soon as she was 7. I think 7 was the age, or 9. I think 7.
Yeah. 7.5.
7.5. Beautiful rule. So if you guys have kids, give them a job and pay them. I think what is it, like $12,900 a year or something?
Yeah, it's up to the standard deduction. So currently that's actually like 13,000 something.
Yeah, it keeps creeping up, right? So beautiful. Guys, there's all these strategies. And to your point about the rich, you know, senators that own these homes and they pay lobbyists, like, look, if it's legal for them, we can, as the peons, we can also use these rules, and we do for every single reason they do it. And it's legal for them. And, you know, and I think it's funny. I think, and you'll get a chuckle out of this, like, you know, just throw Trump's name in the world. Like, he's got all these, you know, high paid tax attorneys and lawyers that help him mitigate taxes legally. So he doesn't pay taxes, even though he makes hundreds of millions of dollars a year. And me and you, John and Randy, we're like, hell yeah. Like, high five to him. But all the everybody else is like, he should pay his fair share. It's like, he's not breaking the law. He's using the leverage of the tax codes. Right. And so he's
literally paying his fair share.
Yeah.
If you're overpaying, that's on you. Don't overpay. That's not your fair share.
Exactly.
Well, one thing I wanted to get to, John, you mentioned that there are 2 buckets from Profit First that you added each time that you were working with microgyms. Can you define what those 2 buckets are that maybe the Profit First model didn't clarify? I mean, I'm sure for our listeners are important.
Yeah, totally. And one last comment, whether it's Trump or any other rich person, just so you know, don't ever overlook the other taxes that they're paying. Those guys pay more in payroll tax than you'll pay income tax in your lifetime.
Right.
So talk about paying your fair share. Let's why don't we put our energy in other fights? Okay. So profit first accounts. Let me actually give you all 7.
Sure.
So there's an income account, an owner's pay account, team members. That's one of the ones we added. Profit account, tax account for income taxes specifically, because payroll tax, sales tax, those are considered operating. Equipment, that's the second one we added. And then operating expenses.
Awesome.
So you add team members, you added equipment, because obviously equipment every so often, right? You're going to need, I think you put 5%, right?
Yeah. So with that, we actually have clients do one of 2 ways with the equipment. So some are just like, I'm going to put a flat amount into it. Cool. That's great. So every time that they sit down and take money from their income account into the other buckets, they do a flat amount. All right. Others do a percentage. Both are great, because the beauty about profit first is that it's a methodology. You got to pick what you know you're going to be able to stick with from your behavior standpoint. The other thing that we see with the equipment account is gym owners will get to the point, and we recommend everyone has this number in general, but it's like, man, if everything hit the fan, what's the most I'm likely going to have to pay to replace or fix my equipment at any given time? So maybe that's $3,000. As soon as the equipment account hits $3,000, then some choose to stop allocating money to it. Others are like, you know what? I'm going to keep putting money here as a growth opportunity. Maybe something is going to happen and I'll be able to expand the location. I can add a little bit of equipment that way, or I want to buy a building. I can save up for a down payment in here. And anything above that 3,000 or whatever the dollar amount is they determined is kind of their money for like growth opportunity. So we've seen it used in those different ways.
Smart.
And John, if this hasn't been invented yet, if you could just go ahead and invent this real fast, it'd be amazing. There, like, and I know Mike Michalowicz has teamed up with another bank, but like, is there a piece of software that I can plug into my Chase account, and for every deposit that hits, automatically distribute into the other 6 buckets in real time my percentages?
So in real time, there's not one that exists. And I actually like the rhythm of having it compile in the income account and then doing it either once a week or twice a month. But RelayFi is the bank that Profit First headquarters like work to deal out with. Yeah. And you can go in and tell it, on these dates, I want you to take the money out of my income account and transfer to these other accounts based on these percentages. Yeah. And it will do that automatically for you.
Yeah. I just wish like every deposit that hit, it would just like take the deposit and then the next morning go across, and like you would never have to look at it, because all the bills are coming out of your, OPEX or whatever. And I just hate going in there and tweaking stuff.
I know, I get it. But I actually, like today, for example, is the 25th. So today is what I call an allocation day. And earlier this morning, I transferred my money from my income account, and I like it because I track it. I'm like, hold on. Like, it seems like the dollar deposit amount is less than my last average for this time period. So I was able to talk to my accountant or our in-house controller. Like, hey, what's going on? He wasn't up to date. The books are only done through the 21st. So
got it.
He still got 4 more days. I was like, okay, good. That at least makes me feel a little bit better. But if not, it's like, yeah, all the deposits are there. Okay, what the heck happened? Did we have a bunch of cancellations? So it can, like, the balance being different from what you're expecting it to be can help trigger some questions.
Okay. It gives you clarity on where the money is and where it's going. And I mean, it's your way of making sure that things are as they're supposed to be, I guess. Yeah.
Yep. So what's going on with this new book? Is this is just like a different niche here? Or are you talking about working less and creating more? What's it all about?
Yeah. This is a book for basically everyone. It's not gym owner exclusive. So the concept is that your most efficient workday involves working up to 3 hours, followed by a 30% recovery period. So 3.3, the 3 means up to 3 hours. The 0.3 is your recovery period of 30%. So if I worked an hour and a half block, I should take a half-hour break. If I worked a 3-hour block, I should take an hour break. The reason I found that this works is because, first of all, our 40-hour work week, 8 hours a day, the way it's structured, is literally based on nothing more than Henry Ford pushing this through about 100 years ago, mainly so that people had more leisure time so they would buy more cars.
Okay. All right.
And that's
Smart.
our workday, our current 40-hour week.
Yep.
Studies show that our focus is like a muscle. It can get fatigued. So the idea is, it's not attention span. Based on the study, that's no longer an accurate term, because our attention is always on something. But if I'm focused, my attention after a certain amount of time is going to drift somewhere else. The guy saw this study. His name's Alejandro Lleras from the University of Illinois. He's the one who did this study. And he noticed some other studies that was from a physical sensation standpoint, like our clothes, for example, our body neutralizes the stimulation of our clothes. So up until this moment, you just forget you had a shirt on, but now it's like, oh, I can feel the cloth rubbing against my skin. Our brain neutralized that stimulus. He said, I wonder if the same thing happens with attention. So he did a study, and he did find that, in fact, it does. And so that means our productivity decreases. So if we give ourselves permission to take breaks and do nothing work related during that break, we will actually come back and be more efficient. So we just set up these blocks. So that's kind of the general idea of what the 3.3 rule
is. Does it play? I mean, I don't remember exactly what the ratios are, but like the Pomodoro principle, right?
It's very similar, right?
Similar?
I talk about that in the book. If you look at the Pomodoro ratios, it actually works out to be about 30% break time versus work time. The challenge with the Pomodoro rule, which, for just so you guys know, it's tomato in Italian, because the guy who created it was using a tomato timer. It's like shaped like a tomato.
Okay, there you go.
The problem with that approach is that sometimes we get in the groove and we're focused. If you're focused and working on something, like for me, I know it's weird, but forecasting in Excel spreadsheets, man, I love that stuff. And like an hour or two can pass and I'm just in the zone. Pomodoro would interrupt me every 20 minutes and it would actually ruin my flow state.
Sure.
So it's a little bit, that methodology is a little too strict. This one gives you flexibility based on what you have going on. Like, for example, we talked about Mike. Mike is more of I call him a sprinter. He likes to write for about 52-minute blocks, and then he takes, 10 to 12-minute break when he's done. And that helps him. When I was writing the book, I was more of an hour and a half, 30-minute break type of guy. Because again, it really just depends on who we are. And that's why we need the flexibility with the focus versus recovery blocks.
I like it. We work with a lot of business owners on their production and their mindset and things like that. So, I mean, obviously that's a skill that translates to the business, that helps with the dollars and cents, but it's it's not the same skill sets that a lot of us are used to, working on and training. I mean, it's not as easy looking at a P&L and saying, oh, here's the gap. You know what I mean? So I look forward to reading that one.
Yeah.
Okay. It comes out in January, guys. Go pick that up. Was it going to be on Amazon?
Yeah, you can pre-order it right now on Amazon.
Oh, there you go.
Awesome.
Get that pre-order out there. Nice. So we kind of jumped around a little bit. John, like if somebody wanted to, work with you, you got 450 clients. You taking on any more clients right now? Is that, are you
yes,
guys,
sir. We will never say no. We'll just keep growing.
Keep growing. Yeah, might as well. Unlike some gym owners, when we used to run ads for them, they would say, turn the leads off because we can't handle it. Like you got to make hay when the sun shines, right? Like that, you've got to take advantage of it. So what's the best way if somebody wants to say, hey, we want to work with you, do the profit first stuff, maybe work with you in the tax stuff? What's the best way?
Yeah, so profitfirstformicrogyms.com is a great place. And if they're just looking for a straight up, hey, they want to get in contact with someone on our team, our tax firm is Incite Tax. So it's incitetax.com. And that is spelled, the word insight means to cause to action, often used in the phrase to cause a riot, because we think the IRS sucks. So it's INCITETAX.com.
Yeah, Incite a riot. That's true. Yeah, so we're cut from the same cloth, John. I'm willing to pay what I'm supposed to, not a penny more. And it's, if you're paying a penny more, what did you say, John? It's your own fault, right? There's all these things out there. Right on. All right. Well, that wraps it up, guys. Hopefully this helps you. John, thanks for joining the Built to Grow podcast. I appreciate what you're doing for gym owners out there, helping them win. Guys, Randy, thanks for joining as well.
Glad to be here as well.
All right, John. Thanks, man.
Thank you.
Bye. All right. And thank you for listening to that episode of the Built to Grow podcast, where we help gym owners win. Now, do you want to connect with me and other gym owners online? All you need to do is join our private Facebook group, Business Talk with Fitness Professionals. Just head on over to Facebook and type in Business Talk with Fitness Professionals. And when you do, we're going to give you our 10 marketing strategies 7-figure gym owners use to win. I look forward to seeing you in the next episode. Until then, keep building something great.